Welcome to today's deep dive on how to handle an international inheritance when you're tempted to retire early. We'll unpack the real numbers behind FIRE, the hidden traps of cross-border assets, and a practical action plan to convert windfalls into true, liquid financial independence. Stay with me to the end for clear steps and a reality check before you hand in that resignation. Before we begin, a quick disclaimer. Nothing in this video is legal, tax, or investment advice. Your situation is unique, and cross-border planning is complex. Always consult a qualified tax professional, attorney, or fiduciary financial advisor who understands both jurisdictions relevant to your inheritance and residence. Here's our roadmap. First, we'll frame the context and the exact FIRE math. Next, we'll break down currency risk, taxes, and concentration risk, the euro trap. Then we'll examine why real estate often fails the liquidity test. After that, we'll clarify what to exclude due to Usufruct constraints. We'll follow with a step-by-step action plan to turn illiquid assets into a diversified, liquid portfolio. We'll then compare debt paydown versus investing. Finally, we'll test your understanding with 2 quick quizzes and close with key takeaways. First, let's set the stage. You've received an international inheritance, and the idea of early retirement is understandably tempting. However, FIRE relies on a disciplined rule of thumb, accumulating a liquid, diversified portfolio equal to roughly 25 to 33 times your projected annual expenses. For U.S. residents, the bar is typically higher because of healthcare costs, taxes, and lifestyle expenses, which often pushes the true target above $2.5 million. Therefore, the windfall might place you close to the goal, but not necessarily across the finish line, especially if the assets are illiquid or concentrated. Next, let's quantify the FIRE math. A common benchmark is 25 times annual expenses, which corresponds to an initial 4% withdrawal rate. However, given sequence of returns risk and potentially long retirement horizons, many opt for 33 times to build extra resilience. In the United States, healthcare, taxation, and the overall cost of living often push families toward the higher end of this range. Critically, the composition of wealth matters just as much as its size. Liquid, diversified assets are what actually fund retirement with reliability and flexibility. To make this concrete, here are example targets. At $60,000 in annual spending, you'd aim for approximately $1.5 to just under $2 million. At $100,000, you're looking at around $2.5 to $3.3 million. As expenses climb, targets scale quickly. This perspective helps you evaluate whether a windfall truly supports retirement without additional employment income. Meanwhile, international assets introduce the euro trap, currency risk, and complex taxation. Currency swings between the euro and the US dollar can materially change your real spending power year to year. In addition, foreign income may be subject to withholding taxes, and you'll need to navigate treaty rules and reporting requirements. Diversification is also a concern. Concentrating assets in one country or currency adds risk that can be reduced by broad global exposure and appropriately domiciled funds. Furthermore, real estate often appears attractive. 2 apartments netting over €3,000 per month sounds strong, but beneath the surface, maintenance costs, vacancies, property management fees, and foreign taxes erode returns. The biggest issue is illiquidity. You cannot reliably sell quickly or at a fair price during market stress. Managing properties from abroad increases operational complexity and risk, which is the opposite of what you want in a lean, early retirement. In addition, relying on about €5,000 per month in dividends from a single private company represents a concentration hazard. This is a single-point failure. If the business underperforms, dividends can be reduced or eliminated overnight. The solution is to assess the cost basis, verify whether a step-up in basis applies for the inherited shares, and develop a path to liquidate and redeploy into diversified, low-cost global index funds. Consolidation and diversification reduce risk while improving reliability. Also, if another party holds Usufruct over certain assets, you don't have control or immediate access. That means they must be excluded from your current FIRE projections. These assets might have future value, but today they do not fund your retirement. You should only revisit their inclusion when the Usufruct ends or terms change, and you have legal, practical access to income or principal. Now let's move into a concrete plan. First, inventory every asset and liability across jurisdictions. Second, Confirm whether a step-up in basis applies to the inherited private shares, and record the cost basis carefully. Third, map tax exposures, including foreign withholding, U.S. reporting such as FBAR and Form 8938, and any applicable treaty provisions. Fourth, prioritize liquidity by planning staged sales of private shares to minimize market impact. Fifth, convert euros to dollars strategically, using batches or dollar-cost averaging to reduce currency timing risk. Sixth, reinvest proceeds into low-cost, globally diversified index funds, and as a U.S. person, prefer U.S. domiciled funds to avoid punitive foreign fund taxations. Seventh, create a liquidity sleeve, typically 1 to 3 years of spending in cash or short-term bonds, to reduce sequence of returns risk once retired. Eighth, retain your high salary until your liquid, diversified portfolio meets the 25 to 33 times expenses threshold. Ninth, address debts by paying off any high-interest obligations first, while leveraging any low or 0% inheritance tax loans as cheap capital during your aggressive investment phase. 10th, assemble a professional team that understands cross-border issues, a tax professional, an estate attorney, and a fiduciary financial advisor. Next, this flowchart walks through the quit or keep working decision. It begins by checking whether you have liquid, diversified assets at or above 25 to 33 times annual expenses. If not, the path is to keep working, aggressively save and invest, consolidate illiquid assets, convert euros strategically, and purchase global index funds before reassessing. If you do meet the threshold, it then verifies whether you have a healthcare plan and a liquidity sleeve of 1 to 3 years in cash or short-term bonds. If that is missing, you build it and reassess. If covered, the next check is whether cross-border tax and reporting are fully addressed. If not, you engage a cross-border tax professional and implement the plan before reassessing. Only after all gates are cleared should you consider phased retirement. The diagram also flags to exclude Usufruct assets from calculations and to diversify away from single company dividends. After that, let's tackle debt. If part of your inheritance involves low or 0% inheritance tax loans, use them as cheap capital while you invest at higher expected returns in diversified markets. However, any high-interest debt should be eliminated immediately, as it is a guaranteed drag on your net returns. Keep an eye on interest rate reset schedules and any currency exposure, particularly if obligations are in euros while your spending is in dollars. Now, let's compare two paths. On the left, investing aggressively makes sense when your loan rate is low, say 0 to 3%. Your salary remains strong, and markets are expected to outpace your financing costs. It also accelerates diversification. On the right, paying down debt is preferable when your loan rate is high, variable rates are likely to rise, the debt is in a foreign currency you don't intend to hold, or you place a high value on the psychological benefit of a clean balance sheet. Quiz time. Which asset should you exclude from your current FIRE calculations? Is it A, a rental property in Europe netting €3,000 per month? B, a private company share paying €5,000 per month in dividends? C, an inherited asset where someone else holds Usufruct? Or D, a U.S. domiciled global index fund? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. An asset subject to another party's Usufruct must be excluded from current retirement planning because you do not have access or control over it. Only when Usufruct ends can it be factored into your FIRE calculations. Now take a look at this sample pre-FIRE allocation. It emphasizes global equities for growth at 65%, investment-grade bonds at 20%, cash and short-term instruments at 10% to fund near-term needs and mitigate sequence risk, and a small diversified real estate slice at 5%. This is only an illustrative example and not advice. The key principles are global diversification and a reliable liquidity sleeve. Moving on. Cross-border compliance is essential for U.S. persons. Confirm whether a step-up in basis applies on inherited assets and maintain supporting documentation. Ensure you meet reporting obligations such as FBAR and Form 8938 for foreign accounts and assets. Avoid punitive foreign fund taxation by preferring U.S. domiciled broad index ETFs when appropriate to your situation. Use foreign tax credits and applicable treaties to mitigate double taxation. Finally, plan currency conversions with both market conditions and tax timing in mind. Second quiz. For a U.S. resident with significant healthcare and tax costs, which multiple is the safer target? Is it A. 20 times, B. 25 times, C. 33 times, or D. rely on dividends without a multiple? You may pause the video now to think about the answer in the video. We will discuss the answer in the next section of the video. The correct answer is C. 33 times annual expenses provides an added margin of safety given sequence of returns risk and the higher costs typical for U.S. residents, including healthcare and taxes. Finally, for visuals, this timeline outlines a practical pace. In the first month, inventory assets, hire cross-border professionals, and verify step up in basis. Over months 1 to 3, stage sales of private shares, and begin converting euros to dollars. Between months 3 and 6, construct the diversified index portfolio and establish your liquidity sleeve. From months 6 to 12, optimize tax filings, refine allocation, and continue saving from your salary. After 12 months, reassess whether you've reached the 25 to 33 times threshold, and, only then, consider a phased retirement if all risk gates are cleared. Here are the key takeaways. First, don't quit yet. Liquid, concentrated cross-border assets do not equal durable fire. Second, target 25 to 33 times annual expenses in liquid, diversified holdings. Third, exclude assets under Usufruct until you have control. Fourth, convert euros thoughtfully while diversifying globally. Fifth, use low or 0% loans strategically and eliminate high-interest debt. Finally, keep your high salary until you've cleared every risk gate. To summarize, a strong salary and substantial inherited assets put you close to the goal, but not over the line. Liquidity and diversification are the essential bridge to real financial freedom. Cross-border complexity demands patience, process, and professional guidance. Only retire after you've converted and diversified euro assets, met the 25 to 33 times expenses test with liquid holdings, secured healthcare, and established a liquidity sleeve. Thanks for watching. If this walkthrough helped clarify your path from inheritance to real financial independence, please like, share, and subscribe. I'd love to hear your cross-border challenges and questions in the comments so we can tackle them in future episodes.